Okay, good morning, everybody, and welcome to this week's edition of our weekly market analysis session. My name is Carl Capolingo. I'm the market analyst over here at ThinkMarkets Australia, and it's a pleasure to be with you as we delve into all the key moves in markets last week and have a look to the week ahead. This week, going to have our customary look at cryptocurrencies, particularly Bitcoin and Ethereum. Then we'll change gears, have a look at stock markets, both local and abroad, the key commodities you need to know if you're holding ASX Resources shares. We'll have a look at the bond market, foreign exchange markets, all the key economic data moves from the week ahead, and more. Kicking off with crypto first. Let me change that screen over. And we can see it was a very good week for crypto. The timing of the big move last week in Bitcoin in particular came around the time of the release of the US CPI data, which was a little bit better than expected. Apart from that, there weren't any obvious catalysts for the big move up. As you can see, Bitcoin leading the way there, up 13.7% in the majors. Polkadot had a very good week, up 18%, and then they kind of fall away from there. We're down maybe 1 or 2% since that snapshot was taken early Sunday morning. In terms of the fear and greed index, you can see that has moved back up to 60, which shows greed as far as Alternative Me, the provider of that index, is concerned. And that's the first time we've been at greed for a very long time. You can see last week we were at 50 at neutral and last month at 51. Moving along to the Bitcoin chart now, we can see that we are just hovering beneath that all-important 25,000 level. Key psychological level, in my opinion, and a key technical level, because you can see back in August last year, we had a significant swing high there at 25,208. Really, that was sort of the best bounce it could achieve after the big sell-off earlier in the year, and then it really did fade away from there. So the fact we're up there, I think, is important. You can see the day where we had the big pop there, that was on Tuesday last week, and that was again in line with the CPI. And the short-term trend has turned up. I think that's also important. So that was neutral last week, you can see, and the long-term trend through our traffic light system is in amber, but with a short-term uptrend and with some nice candles and price action starting to improve. We'd love to see confirmation with a higher trough and higher peak form though. I think you can continue to hold on to your Bitcoin. And as I've said in the recent past, look, if you hadn't participated in the whole crypto phenomenon until now, I think you could do a lot worse than adding the OG crypto around current levels. Possibly a break of 25. Bitcoin tends to move in 5 and 10s. So 25 could see 30, 30 could see 40. 40 would mean plenty of FOMO around the place, and we're back in a bull market. Bear case scenarios, we can see just how well the trend ribbons here are supporting prices. So on the way down, you can see how they resist price. On the way up, you can see how they're supporting prices. So as long as we're staying above those, I think we're still in a new bull market phase. Having a look at Ethereum, it is very much the follower and not the leader. Bitcoin is in the lead. But if we can break through this pesky 1715 resistance level, we could see 1790, and then the 2 handle is not that far away from there. And there's very little resistance, I think, in terms of major swing highs from the past between 1790 and 2031. On the downside, again, note that the trend ribbons are supporting, and until we get beneath, say, a 1450 or so, I don't think you need to panic too much. Let's move back to stocks now, and we can see that generally weaker in Asia. You can see the Nikkei down about 0.6%. In China, the Shanghai Composite down 1%, and in Hong Kong, the Hang Seng down 2.2%. Bit of a mixed bag in the US. The more value-orientated indices, the Dow and the S&P 500 down slightly, but the growth-oriented index, the NASDAQ, up slightly, and that is a nice, albeit small, indication that markets are still feeling a little bit risk on. Volatility net down for the week. In Europe, very strong performance there, up 1.5% in the FTSE. In the UK, the DAX in Germany up 1% and 3% on the CAC in France. You can see volatility still hovering at recent lows there. Having a look to the charts around the region, kicking off with those China charts first. And for me, I think if you're an Aussie investor in big resource companies like BHP, Rio, Fortescue, South32, Alumina, any of the nickel companies, I think you need to keep an eye on these charts. So sounding the alarm, I sounded the alarm last week that something isn't right here. And all I've really seen since then is a continued deterioration in the technicals here. So as much as we're hearing out of Beijing a lot of rhetoric about support, particularly for the ailing, I call it zombie Chinese property market, plenty of propaganda that they're going to support the economy. This is how the money is voting. And we can see here a pretty distinct double top pattern. We can see some pretty bearish candles come in, and we're seeing a retest of the short and long-term trend ribbons. They should offer support. They should offer dynamic support, and they may well still do that. However, if we break beneath, and this level here is about 31.80, I think the Shanghai Composite's in big trouble, and therefore this idea that we're going to have this smooth China COVID reopening, I think that idea would have been dispelled, and we're in for something else. Now, the Shanghai Composite, that represents shares that international investors can buy. This A50 here represents shares that only mainland Chinese people can buy. And you can see it's far worse. Yes, there's a double top, but you can see how we've broken through that middle trough. And actually, instead of supporting prices, we're starting to give way here on those trend ribbons. Look, it's not, the move isn't complete yet, probably below about 13,250. We're going to be in some serious trouble there. But if anything, this is starting to look more like that long-term downtrend is still very much in play. Jury's somewhat still out, so we'll give these charts a little bit more leeway. The two key real estate indexes I like to watch, the CSI 300, we can see that is also breaking down, and in fact never really got above or sustainably above its long-term trend ribbons. The trend here is still down in the Chinese property market, and confirmed I think here in the Hang Seng Mainland Properties Index, which appears to be holding that long-term downtrend zone and slipping again. Now, as bad as those charts look, we're not seeing that reflected yet in the key growth commodities that China is normally associated with for the production of steel that does go into their property sector. We'll talk more about that in a second. The Dow Jones Industrial Average, super quick here because there's not much to discuss. It really is caught in the middle there, around that 34,350 odd resistance level there, very clear, three peaks there now, and then support coming in around about 33,000 till you get a break one way or the other. There's really nothing to see there. The S&P 500 continues to pull back after a very, very strong January performance. Probably no surprise. It is a little bit of a hangover month, I think we're going to find in February, but they do often say, look, as January goes, the year goes. So let's hope, if you're a bull, that these short-term trend ribbons and long-term trend ribbons do offer dynamic support now. They have been so well placed to offer resistance, dynamic resistance in the past. So let us see if they do what I think they will and offer dynamic support, and therefore support and perpetuate this new bull market, as I'm calling it. The NASDAQ, very similar. We're definitely in the zones there. We need to see some white candles and higher peaks and higher troughs come back in. I'll just give you some key numbers. Sorry for going back on the S&P 500. Obviously above 41.96. We're off to the races. It's bull market, a new bull market sort of stuff. I think we're okay until we break below, say, 39.80 to 39.50. Certainly, things are not right. Something's wrong. Something's broken if we get down there. And for the NASDAQ, above 12,270, we're off to the races. And if we get below, say, 11,388, and certainly below 11,069, something is very wrong and very broken as well. In terms of the Russell 2000, it's small cap stocks in the US, again, a really important risk on gauge for us, probably looking better than any of the other US indices we've seen. It is being supported by the short-term trend at the very least for now. The candles last week were actually quite good compared to some not so good candles on the other indices. And I'm taking great encouragement from this, that we are turning the corner in that long-term trend. Look, obviously above 2008, everything is very good. That is a key supply level there. You can see between 2008 and 2030, and beneath, I'm going to say 1845-ish, something therefore it's wrong. Let's have a look at some of those industrial commodities now. And iron ore, that's one of the key components of steel production. We're going to have a look at coking coal a little later on. That's what you mix with your iron ore, and a bit of nickel to get your stainless steel in particular. We can see up 4.67% there in the US dollar, priced fairly flat though in the Shanghai-based contract, but trends still intact short term. Long term trying to change. You can see there through the traffic light system. I'd say if we can get back above 130, all is good for the China recovery picture. But if we roll here, if we see another peak put in beneath 130 with those black candles and upper shadows, something's wrong. And then if we break, say, 118, which you can see there, two key swing lows, then we are rolling over in this one, and alarm bells will be ringing for our big iron ore companies. And indeed, for the China growth story, and probably even for the global growth story. Something I'm very concerned about is that 7.6% fall in nickel, and I've got a chart of that coming up soon. Having said that, probably should have mentioned it just before, but copper up 1.5% in the US-based price there, and we can see it on screen, bouncing off that very important 393, 394 level we'd been talking about. We knew at 436 with that big shadow that came in. So this one here, after that we said probably a bit fatigued, probably going to get a bit of a pullback into the moving averages and into the demand zone there. And look, we saw sort of a nice bounce on Thursday. Wasn't really followed up on Friday, but the lower shadow is encouraging. And I can see this moving back into maybe, 430, 436 to retest that recent swing high. I would say if we do get below, say, 393, something is wrong with that thesis. And again, with that global growth story. Do get lots of people asking me about Australian copper stocks. Hey, Carl, what are the best copper stocks to buy? Or copper mining ETFs. And I say there's so much that can go wrong with your copper companies, because at the moment they are facing rising costs of labor, rising costs of fuel, really crimping their profits. And therefore, because, share prices are a direct reflection of those expected profits. Share prices aren't responding as much as you might think they should, given the underlying move in copper. And at ThinkMarkets, we do have a high-grade copper contract. You can trade it with our CFDs. And I always say, if you think copper's going up, just buy copper. If you think gold's going up, just buy gold. Sometimes this idea, and we default to this, don't we, as Aussie investors, commodities going up, I need to find stocks that are mining that commodity. I think in this day and age where we have access to these products, just go trade the underlying commodity itself. Nickel, if you've got nickel stocks, I think you need to be concerned, because the price of nickel is rolling over. I think it's rolling, I was going to say big time. There may be big times an overstatement. We're still holding that long-term trend, but we're about to break it, to be fair. So we are rolling, and that's not looking good for the global growth outlook. Lithium carbonate futures here have rolled already, and I know there are still plenty of true believers out there in the lithium space, but I think you need to have a look at what's happening here and understand that this could potentially fall a long way, first time below 400,000 yuan per ton on that contract. The lithium hydroxide price continues to hold up. Obviously, this is you need to process your lithium carbonate to get into this. This is more of a battery precursor, so it tends to hold its value better and have a bit of a premium compared to the previous contract. But it is starting to get to the point where, if it does break, say, below 73, start to get below that long-term trend zone, then it's going to look in trouble. Having a look at gold now, we did say over the last couple of weeks, well, certainly we said once we saw this big black candle to start to trim your gold positions and trim some of your ASX equity gold positions as well. I think that was a good call. We did say 1825 as a possible target here from those candles that we saw after the drop, which were very much supply side candles. And we saw that target hit on Friday night, but then we saw a bounce back off it. I'm not sure whether this is the beginning of the next long-term leg up in gold, or simply a bit of a bounce to form a second peak, a lower peak, and really end that trend. But I do think we will get a bit of a bounce. I'm looking at maybe 1870 to 1880, maybe some upper shadows just nudging towards 1890 there, and we'll see how we go. I mean, if you do get those shadows in there, we are probably rolling in this long-term trend in gold. If we can hit that level with some white candles and lower shadows, much like the candle we saw there, then we're okay. But for the gold bugs out there, some hope, a glimmer of hope, but still very, very cautious on gold's prospects going forward. Still very cautious on the prospects for crude oil. I can't see anything substantial in the candles, the price action, or the trends to suggest that this is going to turn up and boom anytime soon. We're not going to see a Bitcoin style bounce here. If anything, the long-term trend probably will continue, and we are seeing 83.34, 82.66, 80.62. These swing highs coming in lower and lower here, and really this level at the 70 handle is the only thing holding up. Beneath that, we're looking at 65 and maybe even 62.43. So you can see during the week, oil prices were down again. Oil stocks generally lower. Aussie dollar down, commodities, weaker growth outlook, all weighing on the Australian dollar. More broadly speaking, US dollar was slightly higher. The yen probably the worst performer there against the US dollar. We did see Aussie bond yields come down very, very slightly, but the important ones there in the US 10s continuing to move higher and undermine really confidence in risk-on assets, except Bitcoin. Again, we saw the timing coincide with the CPI, but there's very little else I can attribute to that move in Bitcoin. Coke and coal is, again, one of those key components with iron ore for steel production, the US, the Chinese property market, a major consumer there. We're not seeing some of those moves lower in those Chinese indices, stock indices, being reflected here. So something's amiss. There's a disconnect. Who do you believe at the moment? Continue to follow the trends in these commodities. I can't see anything so sinister here that would suggest that this will turn down anytime soon, but obviously remain on alert. Because some of those equity charts in China are coming off. We're going from growth coal previously to keep warm coal here. And much like I think what is beginning to happen in lithium carbonate, potentially the lithium hydroxide prices, this one has rolled. And you can see when they do get going, the momentum is quite sharp to the downside. Nothing in that thermal coal chart to suggest that we're going to get a bounce in price anytime soon. And we're seeing that consistently through the keep warm trade. So we saw crude oil prices down. No reason to think there's going to be a bounce. Thermal coal prices down. No reason to think there's going to be a bounce. Natural gas prices in Europe. No reason here to think there's a bounce. And the key levels still awaiting us there at 144. If you haven't registered yet for my live market analysis sessions during the week, we do talk about this one on Thursdays. And there's a key level there at 144. We're watching closely. We're going to wait till we get there with the right candles, and there might be a cheeky /kamikaze buy down there. But until then, I think you can trust the trend, and we are seeing energy commodities weaker and weaker again. Not this one, however. This one bucking the trend, but not by a huge amount. So for the uranium bulls out there, I think this one still looks very constructive for a continued move to the upside, albeit with limited upside around that 52.80 US per pound. The US dollar does undermine some of those commodities there because they are priced in US dollars. It had a slightly stronger week, as we mentioned before, but coming off highs on Friday. We had talked about the prospect of a move into 105, 106. We said we're going to watch the candles there. Friday's candle does look a little bearish in that level. We are seeing supply, or at least the early fingerprints of supply coming in around that level. One candle does not a reversal make. So let's see how we go with the next few. Again, black candles or upper shadows in that area would suggest that the US dollar is starting to come under pressure. And that could help some of those commodity prices as well. If we see the white candles print this week, it means that we are going to go high here. And if we break that 105, sort of 50 level, we could see 107, 108 as the next move, and that would see the Aussie dollar probably push down and complete the move into 66.80. You can see around there 67, but Friday's candle does cloud the technicals here a little bit because we are seeing some demand come in even around that long-term trend zone. It is starting to show a little bit of dynamic support. I think you need to be neutral here. I can't neutral. Look, there's still a possibility, probably, I know I'm hedging my bets a little bit, that with the right candles, we can move into that 67. So to say neutral, I think I misspoke. And let's say skewed towards the bear case in the very short term. Okay. Australian government bonds. So we're talking about just a quick snapshot here on interest rates. Are they rising? Are they falling? If they're falling, that's good for stocks. If they're rising, that's bad for stocks. And they're more on the rising side of the equation, aren't they? Having a look at the US 2s, they continue to edge higher, although they are starting to slow down in the momentum. We're talking about the yields here. Obviously, the bond prices are heading in the opposite direction for bond yields to head up. And a little bit of a slowing in momentum there with that candle on Friday. Again, matching that US dollar move, reaching up and failing into 390. A pullback here will send stocks higher and into bull market territory. A continued rise here will destroy that thesis, and we'll see some of those key levels to the downside that I said, look, let's hope we don't get there, something's wrong, some of those levels tested. It's all about interest rates at the moment, and it's all about this chart here. This is the US yield curve, and ideally, if you're a stock investor, you want to see that orange line, which is the current line. You want to see it coming down, and you want to see it flattening out, so eventually it can go back to very low in the short term and much higher in the long term. But it is still looking very risk averse here, heading higher and remaining its inversion, its steep inversion there. So that is often a precursor of recessions. Having a look at some of the data during the week, let me put myself away there so you can see the full chart. Consumer price inflation in the US cooled somewhat, and we did see that was the catalyst for that Bitcoin rally. The headline came in at 0.5% January versus 0.1% December. Now that sounds hotter, but the core was only a small gain at there, 0.4 versus 0.3% previously, but it was the headline coming down to 6.4 versus 6.5, showing some cooling, well off its 9.1% peak in June last year. And the core, stripping out there the volatile food and energy components, that came in at 5.6% annual, and that was down from 5.7% December and well below its 6.6% peak. Roughly half of the January inflation came from rising shelter costs. Now, about a third of the CPI comes from shelter costs, and we know that that was up 0.7% in January for a 7.9% annual gain, so still much hotter than that overall rate, and energy still hurting consumers and giving Fed cause for concern. They're up 2% for the month, 8.7% annual. It is slowing though, but food also still going at a 10% rate. So when you look at shelter, you look at energy, you look at food, the biggest components of anyone's normal spend, this is still very, very high, and still very, very detrimental to US economic growth. Having a look at the wholesale inflation, often a precursor for that consumer inflation, it disappointed the markets. Markets fell on this news, 0.7% in Jan versus the 0.2% revised, up from 0.5% fall in December, and that was the biggest increase since the middle of last year. Headline wholesale inflation 6% per annum. That is still cooling though from the 6.5% in Jan and well off the 11.6% March peak from last year. Core stripping out again, volatile food and energy up 0.5% in Jan versus 0.3% December for a 4.4% annual gain, and that did slow from December's 4.7%. But it was the headline number there higher than expected that hurt investors. Let's have a look at some of the data closer to home here in Australia. Consumers fret COL pressure. What does COL stand for? Cost of living. So cost of living pressure is still on the rise, and many consumers there had hoped that the RBA would cut rates, or at least pause, and they kept increasing rates. So that was a great disappointment. We saw that the consumer sentiment index fell 6.9% in Feb to 78.45, and you can see there we are around the lows and certainly recession level readings here. Consumers are facing quote unquote intense pressure, according to the survey, on their household finances and major household purchases index. So, you know, if you're only going to buy something big for your home, if you're confident about your situation, that is near 50-year lows. However, job confidence remains resilient, but is showing signs of weakening. Not a great reading there for the Aussie economy. However, Contrasting that somewhat, business confidence did bounce back. We saw conditions up 5.5% and confidence up for 5.7% points. Profitability and employment conditions bounced back in January, particularly in retail, construction, manufacturing, and confidence has improved as global growth expectations have improved and local economy proving to be more resilient. Forward orders, there's evidence of that, up 3 points. At capacity utilisation remains near record highs, but cost pressures remain in the system, with purchase costs up 3.2% quarter on quarter versus 2.6% previously, and labour costs continuing to rise, albeit 2.7% I would suggest is fairly modest, up from the 2.1% previous. So a little bit of a mixed bag there in terms of Aussie economy, reflecting a little bit of a mixed bag here on the Aussie market. It continues to pull back. No surprise to us. We said it was probably going to come into 73, 76. If it was to fail, if it was to bounce there, we'd go back and test those highs. If it was to fail there, and that's the scenario we're in, we could see 72.57, which based upon today's very early move, I can't see any reason why we wouldn't get down there. The candles don't look good. We didn't bounce. We didn't see the right candles. In fact, we saw big black candles coming in this zone, little bounce here, but then wiped out here. 72.57 for me looks like a lock. See how we go there. White candles, lower shadows. We're going to get a bounce from here, and then we're probably okay. A failure here, black candles, upper shadows. We're going to see a further move down into this long-term trend zone around that 71, sort of 71.60 area. Okay, so not looking too good on the technicals there for the Aussie market, but I'm not going to write it off completely yet because the long-term trend has turned up. In terms of sectors, financials got hit. We had the CBOE half-yearly report there. That was down 5-6%, and that accounted for much of that decline. Generally, investors reacting poorly to a slowing in the improvement of their net interest margin towards the end of last year, and therefore probably a slowing of profitability going forward. Gold fell. Why? Gold prices were down. Energy fell. Why? Energy prices were down. Resources were subdued. We did see many of those commodities lower during the week. Defensives, your staples, your telecoms, utilities, they were strong during the week. Property trust, not sure about that. Probably just a little oversold. Healthcare, information technology, discretionary, not too bad, but not all that great either. Having a look at, sorry about the camera going off and on there. Having a look at the market breadth, it has significantly deteriorated here to the point where we're starting to get a little bit concerned. It wasn't that long ago. You can see the reading even from last week. We were really solid. We were in sort of near bull market conditions. But what is so concerning here is just how quick that deterioration was. Look, I'm not going to say when anywhere near a bear market, but looking at the long-term trends looking at the sector trends, quite a bit of damage has been done last week. And when the damage is done so quickly, that's when I think you start to get a little bit concerned. Energy now to a short-term downtrend, as financials and gold, materials now in a short-term downtrend, utilities in a short-term downtrend. Also, information technology holding at neutral, the overall index at neutral, and the rest there at up. Long-term trends generally hanging in there though, but potentially something like, I'm going to say under pressure, definitely utilities under pressure. Information technology, that's really a line ball. Discretionary is not so bad, but otherwise in terms of maybe ups under pressure, financials, that one could go to neutral. Energy certainly could go to neutral in the not too distant future, and maybe even materials, but that's probably still early days. I think materials still intact to the upside. Having a look at value across the Aussie market, 15 we say is fair value, and that's pretty much where we are. So we did potentially get ahead of ourselves in January in terms of cheaper sectors, looking at the current compared to the pre-COVID long-term average. Energy still appears to be cheap, but cycling, a big bump in earnings. That will probably double over the next 12 months, so I wouldn't necessarily call that out. Materials, you can see somewhat cheap, but again, still cycling much of those earnings bumps. Staples, not too expensive there. Telecoms looks crazy expensive. Utilities probably on the cheap side of things. Going to the top of the list, discretionary, starting to get back more on the expensive side, but not crazily so. Financials still on the expensive side. Healthcare, I would say, looks expensive, and infotech probably at fair value. Have a look to the week ahead. We've got the wage price index coming out on Wednesday, expecting a 1% quarter-on-quarter rise there. But otherwise, I'm going to say pretty quiet week for Australia. Looking abroad, we've got some manufacturing and services PMIs there in Europe, UK, and the US. FOMC meeting minutes Thursday, 6 a.m. Sydney time, will be very closely watched, as will preliminary GDP data. But probably the big one, apart from the FOMC minutes for me, will be the core PCE price index. We're expecting a 0.4% month-on-month gain, and that is the Fed's preferred measure of inflation. That's why that's important. And they do look also very closely at personal income and spending. I mentioned the Thursday sessions there at 1 p.m. where we cover indices, commodities, foreign exchange, and crypto. Your questions versus my charts and analysis. Hey, tomorrow you can tune in for the ASX edition. That's Tuesday at 1 p.m. And then if you're looking to trade your US shares, like your Teslas, your Microsofts, your Amazons, your Apples, hey, even if you've never traded them before, certainly tune in on Friday at 12 p.m. And get a bit of an insight to how they're tracking along. You can register there at www.thinkmarkets.com/au/webinars. If you're not already a client of ThinkMarkets, well, you should be, because we are the good guys in the Australian broking industry. $8 flat rate trades, CHESS sponsorship for your equities trades for your self-managed super fund. But if you're looking to trade any of those other markets, we talked about trading high-grade copper, potentially natural gas, all those weird and wonderful things you can trade on our platform there with market-leading spreads. And we are actually commission-free on overseas shares like those US shares. We're an award-winning broker, easy-to-use multi-asset platform, world-class at trading apps, dedicated account manager. You cannot fault our support. That is why we keep winning those awards. If you like what you saw today, please hit the subscribe button on whichever platform you're on to stay notified of future updates. And if you like what we're doing here, please hit the thumbs up button to let us know. So we'll keep doing more of it. Apart from that, it has been a pleasure chatting with you today. All the best for your trading and investing until we catch up again. Bye-bye for now. Just a reminder before you go, everybody, everything we've discussed today is general advice. It has not taken into account your personal financial circumstances or particular needs. So before acting upon any of this general advice, you should consider it carefully or seek the help of a financial professional. Otherwise, if you've got any questions about ThinkMarkets or our products, please head to our website, download our PDS, our product disclosure statement.